In this video, I want to show you how you can perform a customer profitability analysis by using activity-based costing. So first off, why would you even want to do a customer profitability analysis? Well, think about it like this. You might have a company that serves multiple different types of customers. They might have certain businesses that they sell to. They might also sell directly to consumers. And then maybe they also sell to the government. They have some government contracts. And so they want to go and say, okay, which of these customers is the most profitable? And if you can find out that maybe one of these customers isn't profitable for your company to be serving, then you don't want to be serving that customer anymore. You might want to get rid of an unprofitable customer, or you find some way to convert them to being a profitable customer. So now I want to show you an example of how you would go about actually doing the calculations to analyze the profitability of different customers. So let's say we have a company called Custom Course Packets, and they've hired you, you're an analyst, and they've hired you to calculate the profitability of 3 different customers that they have. They serve individuals, okay, that's one type of customer, and then they also have businesses, corporations that purchase course packets from them, and then they have universities, okay, so they have these 3 different types of customers. And so they've identified, they track the information by customer type for revenues and direct costs. Okay, so revenues for individual customers, 600,000, for corporate customers, 750,000, and then universities is 700,000. And then here's the total revenue for the company. Okay, so they just break it out by customer type. Now the direct costs are costs that are clearly traceable to a specific customer type. Okay, so if a cost is clearly traceable, where we have this specific salesperson or marketing person that specifically works with the corporate customers, then that person's salary should be traced into those direct costs. If we can clearly link and say there is a direct relationship here to of a certain cost to a certain customer type, then that would be a direct cost. Now, there are going to be other costs where we suspect that they are driven by a certain customer type, but we can't clearly trace it, and so they're going to be indirect costs, and that's where activity-based costing is going to come into play. We need to allocate those costs. So basically dealing with the indirect costs. So what the company has done, or what we are doing as the analyst, maybe they haven't done this information and then we go and do it, but we've identified some cost pools. Okay, we've identified some cost pools, and so we've got several activities that we believe are driving costs. Okay, we've got ordering. Every time a customer places an order, and there's $80,000 to put into that cost pool. And then we also have product design. So maybe every time there's a new course packet that's ordered, maybe there needs to be a new product design for that. And so in that cost pool, there's $20,000. And then there's customer service costs of dealing with maybe unhappy customers, or there's an issue with the course packet and it needs to be redesigned or something. And so there's $30,000 of those costs. So remember, the cost pool is just a bucket. It's just a bucket of costs, and we're saying, okay, look, we've got $130,000 here in indirect costs that can't clearly be traced to each of these customer types, but we know that these customers drive these costs. So how are we going to figure this out? How are we going to allocate any of this 80,000, for example, to individual customers, corporate, and universities? Well, what we're going to do is we're going to come up with an activity rate. We're going to calculate an activity rate for each of these activities. Okay, so we need the activity base to get the activity rate. And so when we say ordering costs, we could divide that by the number of customer orders. So there's $80,000 in cost, 40,000 customer orders. So we could say that's $2 per order. So every time there's a customer order, we'll allocate $2 of costs. Okay. And then product designs, 20,000 divided by 400 product designs. So that would be $50. Okay. And so forth. So $50 a design. And I've laid this out in a table to make it more clear for you. So here's our activity rates. And then the customer service costs. There are any number of activity bases you can use for this, but I use the number of customer complaints. Let's say that company believes that that's the best way of measuring customer service costs. That customer complaints go up, there's more costs driven in terms of customer service, and there should always be a cause and effect relationship here between these activities and the costs. Okay, if there's no cause and effect relationship, that undermines the entire purpose of what we're doing. So 500 customer complaints, 30,000 in customer service costs. That's $60 every time there's a customer complaint. So now we've got our activity rates. And now what we're going to do is we know the activity levels for each customer type. We say, okay, for individual customers, they had 12,000 customer orders, and we just figured the activity rate. Every customer order is $2. So multiply that by $2. Okay, and then there's 160 product designs were used by for the individual customers, and product designs is $50. Okay, that's just from our activity rate. And our activity rate for customer service is the number of complaints is 60. So intuitively, this is saying, look, the individual customers, they had 160 complaints. And we figured out that the rate that we should be charging for each complaint is $60. So if we multiply 160 times 60, that'll tell us the amount of customer service costs that should be allocated to the individual customers. And we're ultimately going to figure the operating profit for individual customers, the operating profit for corporate customers, and the operating profit for the university customers. Okay? So if we go and follow this out, what we're going to end up with, so if we go, so this 12,000 times $2, that would be $24,000, right? So now here's our individual customers. The revenue of 600,000 of the direct costs, those were given, if you remember. So those were just given. So what we had to allocate was the ordering cost, the product design, and the customer service cost. So I just showed you the 24,000 of ordering costs. But if we go 160 times 50, that will be the 8,000 in product design costs. And then the 160 times the $60 for the complaints is 9,600 for the individual customers. Okay. Now, when we go and take the revenue minus all these costs, that gives us an operating profit for the individual customers of $108,400. Okay. And so if you were to divide this profit, by the way, by the sales revenue, you would get an operating margin of 18.07%, just in case you're curious. So now we can go with the corporate customers and the university customers. Now remember, again, the revenue and direct costs, these were just given. I just gave these to you. These were tracked by the company. So the ones that we're allocating are the ordering, the product designs, and the customer service. So I'm just going to go through the corporate customers. I won't go through university because once I figured do this, you'll be able to see. So corporate customers, here we had 15,000 orders times $2 an order. 110, so that'd be 30,000, right? So there's 30,000. 110 product designs times $50 of product design. Okay, so that's $5,500 for product design costs allocated to the corporate customers. And then 150 customer complaints were related to the corporate customers, and $60 was our rate that we calculated for that. So 60 times 150 is $9,000. And again, we take our revenue for the corporate customers and then subtract all these costs, and that gives us an operating profit of $143,000 and an operating margin of 19.07%. Now, if we follow the exact same process for university customers, we get to an operating profit of $131,100 and an operating margin of 18.73%. So clearly here, our most profitable customer type for this company is the corporate customers. It has the highest operating profit and also the highest operating margin. Okay. Now, that does not mean that we should get rid of, for example, the individual customers. In this case, for this company, all three of these customer types are profitable. Okay. So what we're really learning here is that if it comes down to it, the one we most want to keep are the corporate customers. Those are the ones we want to design our incentives or do whatever we have to do to make sure that we do not lose these customers at all costs. Now, if there was somebody, if we had found, for example, that the individual customers, let's say instead of saying 108,400, let's say that we said that, okay, it was actually a loss of $50,000. Then we would say, hey, wait a minute. We're making a lot of money on the corporate customers and a lot of money on the university customers, and we're losing money on the individual customers. Why are we serving the individual customers? Maybe we want to redesign our business where we don't focus or serve individual customers at all. We only service corporate customers and university customers because those are the ones that are responsible for all of our profits.